Greetings to all, and thank you for joining us on this FBN Holdings financial results conference call for 9 months 2024. Thank you again for your time. We do appreciate the time you've taken to join us on this call and for your continued interest in FBN Holdings. My name is Tolu Oluwole. We'll start the call today with an overview by the Group Managing Director of FBN Holdings. And then afterwards, we have a question and answer session. For the question and answer, you can use the raise hand function to indicate if you want to if you want to ask your questions, and then your mic will be unmuted the moment you indicate that. But always ensure that you have the mic muted once you've finished speaking. So without much ado, we will now commence the session today by inviting the Group Managing Director of FBN Holdings, Mr. Nnamdi Okonkwo, for the opening remarks. Please go ahead, sir.
Okay. Thank you, Tolu. Good day, ladies and gentlemen. I welcome you to today's call, where we'll be discussing our September 2024 results. With me on this call, I have my colleagues, the CEO of First Bank, Segun Alebiosu, Wale Ariibi, Executive Director, FBN Holdings, Patrick Iyamabo, Executive Director and CFO, First Bank, Patrick Ahideno, the CRO, First Bank, and Tolu Oluwole, Head Investor Relations, who has already introduced himself. Excuse me. I'm starting with slide 4. Okay. Let me commence by discussing key highlights for the period. Year to date, we have made significant progress towards the achievement of our goals. Specifically, gross earnings increased by 134% year on year to 2.25 trillion. And this was on the back of an impressive 133% increase in net interest income and a strong 83% increase in non-interest income, which demonstrate the effective execution of our strategic priorities. Now, despite the high inflationary environment, the cost-income ratio improved from 46.4% in line with our 2024 financial targets. This resulted in a profit before tax of 610 billion, which is an increase of 128%. On total assets, it's up 62.3% year to date, demonstrating the strength of our franchise. You will recall that we had earlier announced our plans to raise 150 billion naira. This is now underway. Moreover, we're asking approval to raise an additional 350 billion at the upcoming AGM. You may wonder why we're not going straight for 500 billion or something like that. But this capital raise, we had actually proactively commenced the rights issue of 150 billion before the regulatory announcement was made to shore up capital. So we're actually thinking ahead. Okay, so the capital raise will be implemented in one or more transactions through the issuance of shares by way of public offering, private placement, and rights issue in the Nigerian or international capital markets. As we mentioned in our last call, the capital raise will strengthen the group's capital base and will allow us to pursue our strategic initiatives and further invest in automation and digital banking and support our international business expansion. Some people would think that we went out rather late to African market, but today we have spread fast and we're encouraged by the results we see there. So part of this utilization of funds will go towards supporting international expansion. On governance, as you are aware, Segun Alebiosu has been appointed as Chief Executive Officer of First Bank following the retirement of Mr. Adedunto. Additionally, Ini Ebong was appointed as the Deputy Managing Director of First Bank. Furthermore, Adebowale Oyedeji has been appointed as the new Group Managing Director. Wale Oyedeji will be succeeding me because I'm retiring in a matter of weeks from now, in line with our policies. Let's move to slide 5. Okay, as you can see from the numbers, we continue to record very strong performance over the period. We have already touched up on some of the metrics in the previous slide. Here, I just want to draw attention to the improvement in our net interest income, which was up 133% year-on-year and driven by the high rate environment and strong business fundamentals. For non-interest income, it was up 83% year-on-year as we expand our digital banking offer. We remain market leader in that space and have seen an increase in not only mobile and internet subscribers, but also volume and value of transactions. Our loan portfolio has grown impressively, and it reflects our commitment to balanced, high-quality lending. This growth has been achieved while maintaining a well-diversified portfolio supported by our rigorous risk management framework. On deposit base, it has also grown, with nearly 95% of these deposits being low cost at First Bank, our flagship operations. So with 95% of deposits coming in as low cost funds, that's on the positive side for us. And that provides us with robust liquidity to support our group. Slide 6, please. Okay, moving to slide 6, our ROE now stands at 32.8%, well above our 2024 financial target. And it demonstrates our commitment to continue to create value for our shareholders. Our cost of funds has increased slightly to 5.5%. Of course, this reflects the increasing rate environment as well as the cost associated with increase in interest on savings deposits, which, as we know, is indexed to MPR. So as the policy rate increases, you pay more on savings accounts. Net interest margin further improved to 7.9% as we better manage the cost of funds and optimize earnings yield relative to the previous period. As mentioned earlier, cost-income ratio continues to improve as we optimize revenue streams and leverage technology to deliver earnings at pace that outstrips our cost. That's why you see the improvement in cost-income ratio. Finally, cost of risk of 2.7% recognizes the effects of the macro, even as asset quality remains resilient. And we continue to have confidence in the strengthened risk management architecture and practices in the institution. Slide 7. Okay, you can see we're on track to achieve our 2024 targets and our strategic priorities. As you have seen in the numbers shown in the previous slides, we have delivered on our first strategic priority, which was increasing revenue and profitability by leveraging technology and innovation to increase efficiency and by monetizing analytics and data by focusing on new customer acquisitions. So we're also committed to proactively revamping our digital product development and delivery methods. Our second strategic priority was to strengthen our value proposition. To this end, We have leveraged our brand value and focused on extracting synergies across the group. Our goal is to own the customer journey across both physical and digital channels. What we're saying here basically is that synergy revenues have played a significant role across our operating companies because of collaborations and drawing on the synergistic relationships amongst the operating companies. We've seen the numbers keep pointing northwards. Our third strategic priority was to optimize operational efficiency. This has been our focus for some years now, and most recently, we've looked at streamlining our portfolio to maximize our operational potential. As such, and in the face of the increasingly competitive environment, we maintain a forward-looking approach with a clear aim to build a sustainable institution. If you take a look at the right-hand side of this slide, you will see our 2024 financial targets and the progress we've made towards them. We have already achieved the ROAE and cost-income ratio targets. We are making progress towards the achievement of cost of risk target. However, this has been impacted by the difficult macro backdrop, but we'll keep working at it. Let's go to slide 8 now. Okay, so here you can see a few more details on the 150 billion capital raise. In terms of timing, the offer opened yesterday, November 4th, and is scheduled to close on December 12th. There will be a provisional allotment to shareholders on the basis of 1 new ordinary shares for every 6 ordinary shares held as at October 18th, 2024. So shareholders have 3 options: accept their rights partially or in full, with the possibility to apply for additional rights. Second, trade all or some rights by instructing their stockbrokers. Or the third option is to take no action. But then, if you take no action, you get diluted. So we look forward to our esteemed shareholders taking up their rights, thereby supporting FBN Holdings' capital raise agenda. On that note, I would like to stop here, but before we go to Q&A, let me reiterate that I am pleased with the remarkable performance of the group so far in 2024. All our operating companies have delivered some good numbers, and I thank the team members, our operating companies and their leadership for their outstanding contributions. We remain confident in our ability to continue to successfully deliver sustainable value to our stakeholders, despite difficult macro backdrop. So on that note, I thank you for taking time to listen. I will now hand over to Tolu, who will moderate the Q&A. Thank you, ladies and gentlemen.
Thank you very much, GMD. Okay, just as a reminder, you can raise your hand so that you'll be called upon for the questions. Right. Okay. I haven't seen any hand raised so far, but okay, we have so we have a question in the chats in the Q&A section. This is from Nabila. Okay, so Nabila says, given the plan to get approval for additional capital raise at the upcoming AGM, what will you say is the timeline for completion of this additional raise? And the second question here is, what is the core loan and deposit growth as at 9-month 2024? And then she goes on to say, please, can you shed more light on the rationale behind the proposed name change as disclosed at the AGM notice? And then on the sale of the merchant banking business, how much is estimated to be gotten from the sale of this? And will this be channeled towards meeting the shortfall in terms of regulatory requirements? And then finally, given the high interest rate environment, how does the group intend to manage any further deterioration in asset quality? So I think we'll take this set of questions first, and before moving to, because these are 5 questions now.
Sure. Okay, what we'll do, CEO Segun will take the one on asset quality. Wale will take the capital raise question and the timeline it takes to complete. What's the other? What are the other 2 questions?
Sale of
So we have
MB is asking about sale of MB. He's asking
Okay.
about rationale behind the name change.
Okay, I'll take those 2 right away. We like you hear us talk about optimizing our portfolio, and that's a key strategic imperative. And sometime, I think last year during the strategy session, we made a decision to divest from the merchant banking business because and channel our energies to other areas, because it didn't make sense anymore to hold a merchant banking and commercial banking license by our own judgment. So we decided to do away with that. Okay, so capital raise timetable. Okay, so it's SOA. Go ahead, take the others.
All right. Thank you for the question and good afternoon, everybody. The timeline for capital raise, if you followed our story, especially with respect to the right issue, we expect that it will close December 12. Verification by central bank, getting the money, allotment, going to SEC, getting approval, listing the share, all of those things. We expect that by February, end February, we should be able to give the money to First Bank, and that will count for capital adequacy ratio and for the use that we have indicated they want to put the money to from February 2025. Now, the plan is immediately that is done, once we have the approval of the shareholders at this upcoming AGM on November 14 for the up to 350 billion additional capital. Now, we'll start preparation in earnest, and we expect that before Q3 2025, we'll have wrapped this up, and all of that will be in the books of First Bank as capital, Tier 1 capital, and that will, we expect that with that, we'll be ready for Basel 3, we'll be able to compete very well, and the bank will begin to move to take over its rightful position in the Committee of Banks in Nigeria. The second question I would like to deal with is the sale of merchant bank. How much is it estimated, from the sale, and what's, okay, I would rather put it this way, because what we've done, we have announced, we went through a very rigorous process, and we, at the tail end of it, we've written to Central Bank for final approval, as well as Stock Exchange, Securities and Exchange Commission, Securities and Exchange Commission and CBN for final approvals. We expect that cost of sale will be having minimum of 2 times the NAV as at December 2023. Thank you very much.
Okay, Nabila, I hope that answers all the questions. So Tolu?
Yeah, okay. Just there are 2 questions here. So the first, one of the ones we need to, so he said, given the high interest rate environment, how does the group intend to manage any further deterioration in asset quality?
Oh, okay, yes.
I'll take that.
Yes, I want you to take that.
Again, okay, that's one. And then he asked about
what is the core?
Yes, core. So what's the core loan?
Core loans and deposit growth as at 9 months 2024.
Okay. Thank you. The core loan growth As at 9 months, it's about 300 billion naira core. Other ones are devaluation induced. For deposit growth, that is in excess of 1.5 trillion natural, excess of 2.5 trillion natural deposit growth for the period across the group. How do we plan to manage duration? Practically speaking, looking at the 300 billion we've done for a whole year, you will know that we are not lending. So it now boils down to what we've done before the macro issues erupted. And that points to all that we've said in earlier, that the real issue is quality at entry. We decided since 2016 that our book will be such that we'll be able to withstand crisis, turbulence in the economy, moving through the cycle. So we invested, or we lent into sectors that are able to withstand macroeconomic shocks. So for us, one, actively managing the books. Two, of course, curtail growth and loan growth itself. Three, where you need to lend, it must be to top tier names, and most cases, working capital that you know will recycle out. And three, ensure that you have active remedial process, because you do know that customers will also need hand-holding in this period, and that you allow them, to pay over time in case that is required. Appreciating the difficult operating environment. Thank you.
Thank you, CEO. I will encourage us to rather ask the questions, so we'll be able to really, put it in the way in which you really want to ask those questions. But so moving to the next question now, we have a question from Olumide Shole. Olumide, please go ahead.
Okay, thank you. Great results. My first question is for the dividend payments of 40 kobo for full year 2023. I'm not sure if it has been paid. Correct me if I'm wrong. And if it has not been paid, what was delaying the payment? And also, when should we be expecting the trajectory for dividend payment to change? 40 kobo that was declared last year is it's below par. We all know that. So should we be expecting it to change this year, or when? Because this is one question that well in my mind. And also another question is for the fair value gains the bank recorded, the group recorded for 9 months results of about 500 and something billion. Is it trading gain or FX evaluation gain? I would like to be clear on that too. Thank you.
Yeah. Tolu? Can you hear me, Tolu? I think
Yes.
Patrick, yeah, you want to take more questions before we answer, or?
We can go ahead with that question, please.
So Patrick, can you speak to that?
There's a question around dividend, and I guess Wale will speak to that.
Okay, Wale, yes.
Around the fair value
gains.
Gain recognized. We actually posted a revaluation loss, so it's not a revaluation gain. So that's income recognized that was fair valued into P&L represents positions largely from our derivative book. But to the indicative question you asked, whether it had to do with reval gain, no. We had a short position, and so it was a revan loss that was reported during the period. Thank you.
All right. Thank you. Olumide, if I'm right, that's the name of the. So the issue of dividend, board of directors can only recommend dividend. The shareholders at their general meeting will either, approve or not approve. So we have proposed as the board of directors, and it's been approved by Central Bank, and we have told the whole world. But until when the AGM is held, payments cannot be made. AGM is coming up November 14, and immediately the shareholders at the AGM approve the dividend, will pay through the registrar. So be on the lookout. It's just a matter of weeks. Now, the other part of the question is about the trajectory. Yes, we know Forty Kobo does not compare to what our peers are paying. But, our story, if you followed us, you know that this has been able to just grind out of very difficult situation that we found ourselves. So now at the time when we're trying to conserve capital and retain earnings, it has been a deliberate decision to retain earnings as much as possible in the commercial bank so that we don't fall below the regulatory capital adequacy ratio. And retained earnings is a tier 1 car element, which also enables us to use some of the tier 2. Therefore, it's been deliberate until last year when the board decided that it was time to now raise additional 150. So that because it was at that point that we realized that, okay, we've done this retention so far. Going forward, in order to be able to utilize the potential and get the best result, compete, so that we're able to pay proper dividend to our shareholders, we needed to inject more money. So trajectory for dividend payments will happen. In fact, I expect your question is, when do we expect to begin to see 1 naira, 2 naira? It's not proper that in times that you're asking shareholders to bring money for recapitalization, you're also giving them money as dividend. So I will imagine that let the capital raise settle at that point, be able to give in terms of indication of what the trajectory for dividend payment will be. We are at this point crafting a 5-year strategic plan for the group. And at the end of that plan, once it is done, we'll be able to tell precisely what kind of dividend to expect into the future. But obviously, at the end of this capital raise, we have the firepower to do a lot of business, as we have indicated in both retail, wholesale banking, and expansion. And with that, you can expect better profit and better dividend to come in the subsequent financial year. Thank you very much.
Thank you very much, Edie. Okay, we'll take a question from Ifeanyi, which says, so if you could give a sense as to the impact of CRR on the bank, how much of a threat will this be in terms of the bank's performance, and especially given the estimated 150% increase in deposits from the bank year to date? And what strategies are in place to manage this, given that interest expenses on deposits are contributing more significantly to total interest expenses? And then the second question, which is talks about, could you provide more clarity on the 226 billion exchange loss? And is this primarily related to an off-balance sheet derivative play, or is it tied to position against the dollar? If it is a derivative position, when is the expected maturity date so we can anticipate seeing its results? And then the next question is about capital adequacy ratio. We say, could you discuss your strategy to manage capital adequacy ratio, given that Naira devaluation is having some impact on the size of the risk-weighted assets. And the next question is about CAR. CAR was previously CAR was previously mentioned as a key reason for dividend paid in FY 2023, and given the expectation of a higher CAR due to earnings being retained in the banking subsidiary. But that question is incomplete, but I guess the ED actually touched on dividend payment and all. But we can take the other questions on the CAR and the CRR impact and exchange loss.
Okay,
Before moving to the next.
So I would want Patrick to do numbers 1 and 2, while Segun does 3 and 4.
Sorry, which is 1 and 2 now?
Okay, if you click on the chat section, you will see the post by Ifeanyi. It's a bit long. Number 1, the one he talks about, if you could give a sense of impact of 17.25 point rise in CRR on the bank and how much threat it is to bank's performance, especially given 150% increase in deposits.
Okay.
Yeah, and what strategies are in place to manage this given, yeah.
Okay. So let me take a stab, and then the CEO can provide, and Segun can provide additional context.
Okay.
So there's a question around CRR, a question around interest expense from deposit being a challenge, a question around the 226 billion exchange loss, a question around how do we want to manage CAR, given the foreign currency impact. And I believe the person also meant to add and the fact that you can no longer maintain a long foreign currency position. So I'll take a stab at them, and then colleagues can also jump in as the case might be. Now, CRR impact for us has been significant. I mean, just to put it in perspective, the movement from, to 50% between September and date alone has translated to more than 700 billion in liquidity being mopped up. If you wanted to put that differently, if you were earning at 20%, the CBN just issued notes today, right, at about 24%. So if you had to even just think about that in terms of 20%, that is about 140 billion upside earnings that has vaporized. So essentially, the way we see CRR is that it is significantly understating the earnings capacity of our balance sheet, or to put it differently, understating the real strength of our balance sheet. That said, CRR has been going up all year. It's a systematic risk, so we're not the only one that's impacted by that. But we still continue to do quite well. So if you take a look at the financials and that was shared for the first 9 months of this year, you'd notice a couple of critical things. In terms of revenue accretion, we were accreting revenue from all the various lines possible. Net interest income grew spectacularly on a year-on-year basis, driven by our interest income from loans and advances, as well as from our treasury portfolio and treasury instruments. And if you further analyze the growth in interest income on our loan book and our treasury instruments, you would notice that there are 3 key drivers. You have the volume. If you take loans, for example, the volume growth helped propel interest income, but the substantive volume growth itself was limited. The currency movement translated into significant increase in our interest income, and then our yield improvements also drove interest income from loans. When you get into treasury, a combination of volume and yield drove very significant growth on a year-on-year basis. So combined, the interest income growth far outstripped the interest expense growth. Could it have been much more? It could have actually been much more. But then again, this CRR pressure is part of what is the present thing. So we see the CRR challenge as understating our earnings capacity. But nonetheless, given the structure of our balance sheet, we certainly will continue to accrete in this operating environment. Now, if we move on to the next question, which speaks about interest expense on deposits. Again, interest expense on deposit is moving up. But like we've always explained on the call, every time the yield environment rises, every time yield increases, First Bank actually does much better. So yes, interest expense is moving up, consequent on the yield environment, consequent on NPR driving up savings rates, consequent on a number of considerations. But our interest income is growing much faster than our interest expense. And so what you would notice is the jaw. If you do a year-on-year analysis of our net interest income, you will see a significant improvement in our net interest income. And so what have we been able to do? Because we typically have a long position, we've been able to control interest expense growth while maximizing the interest income opportunities. And as a result, this yield environment, which has driven up cost of funds for our deposits, have played out really, really well for us in First Bank, and we expect that to continue. It's the same thing we see every cycle where yields begin to move up. Is the same thing that's playing out again, and we don't have any complaints over that. To the third point around clarity on 220 billion revaluation loss. Yeah, that loss is not coming out of our derivative position. The loss is coming out of our short foreign currency position on our balance sheet. And as you know, if you have a short foreign currency position in an environment where exchange rate is rising or Naira is devaluing, you will suffer a revaluation loss. That is what is playing out. And so you would notice that a revaluation loss has been growing from Q1 into Q2 into Q3. So that is the downside impact of Naira devaluation on our books. However, that is more than compensated through other currency linked earnings upside on our books. So to the derivative you spoke about, so I'm delinking it completely from this revaluation loss because it has nothing to do with this revaluation loss. Revaluation loss is just a short position. On our derivative books, which benefits from Naira devaluation, what you would notice is we've had significant upside from the derivative contracts that we've had in place. And the gains on the derivative contracts we have in place are circa 500. So if you think about it, yes, we had this huge loss on our balance sheet because of our short foreign currency position. But in terms of derivative contracts, which are also FX linked, we had significant upside. So overall, the Naira devaluation impact has been positive for us. Recall I also mentioned that the Naira devaluation impact also shows up in our interest income because those interest income pools are now converting at a higher exchange rate to our functional currency, which is Naira. And so our interest income continues to be propelled by Naira devaluation. To the final question, which has to do with CAR. You raised a very good point around CAR. And I think it's really pertinent today because of the regulation that prevents banks from maintaining long currency positions on their, I mean, historically, if you've been following us, what has typically happened is that every time Naira has devalued, not only have we become a lot more profitable from our long currency position, but the level of profitability has been such that it had always more than compensated in terms of capital accretion to offset any any risk-weighted asset growth. Indeed, previously, every time Naira devalued, our capital adequacy ratio, not only were we more profitable, our capital adequacy ratio also improved. With the CBN regulation that prevents banks from maintaining long foreign currency position, yes, I mean, what banks are now faced with is they can no longer benefit revaluation gains. And as such, the capacity to offset the impact of risk-weighted asset increase on CAR is limited. However, every time Naira devalues, all the foreign currency income streams, whether they're LC related, whether other types of fees, whether it's dollar interest income, those income streams still translate at the new exchange rate, boosts earnings, and accordingly helps replenish CAR. However, not the way it historically used to. So what do we now do? We're a lot more, a critical thing that is supporting our ability to address CAR considerations under the new regulation includes the heightened returns we're getting from our books. The GMD spoke earlier on about the return on equity recognized during the period, and that was north of 32%. North of 32% is in excess of our cost of equity. Those are returns that are very supportive of CAR and capital replenishment to offset risk-weighted asset growth. So that's a big deal for us, which is really, again, profitability of our books. The second thing we do more actively, and we used to do that, but it's a lot more active now, is to have risk mitigants for the RWA growth. So as you know, your risk-weighted assets can grow, but if you've got security in terms of cash or gilt-edged instruments, those represent risk mitigants, and so they reduce your effective RWA. So in terms of structuring capital-consuming risk assets, priority is really around using the risk mitigants to keep RWA in check. So effectively, what you'll see is RWA doesn't grow as quickly or is not as responsive to Naira devaluation. And then the other considerations are really around the currency mix of our risk-weighted assets books, and then other capital considerations that we bring to bear. So collectively, because we have a very robust balance sheet that is really benefiting from the current albeit volatility, but really benefiting from the volatility, that's able to benefit from the volatility. We have returns on the high end that's replenishing capital, coupled with the other things we're doing around structuring, using risk mitigants, and then things we're doing around our currency mix of our portfolio. We're able to address the capital considerations. And for us, the big discussion or critical discussions around capital are really boosting capital to levels that are fully supportive of Basel III and offer us the competitive advantage to tap into some of the opportunities we see the current regulatory environment creating for banks of our scale and balance sheet quality. And so this is a tie back to the earlier discussion mentioned around the capital raise we're seeking to do. So that complementing the organic steps being taken, it would uniquely position us in the market and going forward. Thank you.
Thank you. Patrick has actually addressed number 3 holistically. And number 4, he said dividend payment now that that 2023 he said we wanted to retain capital in this subsidiary. Well, now that we're making a lot of money, we would like to know or double dividend, which Wale, the CFO of Holdco, actually spoke about, that we're raising capital, and you know what the operating environment is saying. Two, that we are in the process of crafting our 2025-2029 strategy. And based on that, we'll be able to project what the future dividend will look like. But I can assure you that going forward, dividend will be materially different from what you see. Thank you.
Thank you, Patrick. Thank you, CEO. Okay, we'll take the next question. Again, just as a reminder, we'll encourage participants to please ask questions. So take the questions from Fanny Stree. Please go ahead.
Hi, good afternoon, and thank you very much for the call. I'm just confirming.
We can't, well, I can't hear you very well. I don't know if that's the same thing for everyone. You're not very audible.
It's quite faint.
Apologies, can you hear me now?
Yeah, better.
Not better.
Thank you.
Thank you very much. Thank you for the call. Just two quick questions from my side. In terms of the Eurobond maturing, I think less than a year from now, do you have any indicated plans to redeem or potentially refinance? And I guess maybe a related question, if the external environment is still somewhat challenging or not conducive, would you also look at a potential USD bond as an avenue for refinancing that instrument? My second question is really on the swap position with the central bank, just to get an indication. How has that position changed year to date? If you don't mind disclosing. Thank you very much.
Thank you. Patrick?
Okay, I think my video is, I'm unable to turn on my video, so if the host can help
It's
me
okay.
out.
It's okay. Yeah.
So
yeah.
that's two things. So there's a question around the Eurobond, and then the second around our swap position with the CBN. In terms of the Eurobond, I mean, we will redeem, plans are already in place to make that happen. Like we've always said in the past, I mean, we want to remain active in the funding market, and so if the prevailing circumstances are right, and by that we mean pricing and other considerations, we will tap the market again to as necessary. So that's why I'll just put that. So two things really. Redemption is not a problem at all, and our access into the market on a business need basis. Luckily, we've got a really great rating. Our credit rating is capped by sovereign, and so our capacity to efficiently raise funds is not in question. Our access to the market is excellent. We actually have people knocking on our doors and asking if this is something we want to explore. So on the funding end, we're quite comfortable with that. In terms of the swap position, I mean, we can't speak to the exact details because those are bilateral, confidential transactions. But what I can say is we do have a couple of contracts running, and earlier in the year we didn't like the terms of rollover of one of the contracts, and so we called it in and we were paid and we moved on. So our continued participation in any currency swap transaction with any counterparty will strictly be driven by whether the commercial terms make sense to us. The good thing is our counterparties have always confirmed and have clearly demonstrated the ability to settle at will if parties cannot come to a commercially acceptable transaction. Thank you.
Thank you, Patrick. Tolu?
And okay, so I have the next question here. Okay, Olumide, surely, go ahead with your question, please.
Okay, thank you. So, can you provide us with a breakdown of forbearance loans? We understand that CBN has granted banks forbearance, and we believe that the bank is also a beneficiary of that. Can you please provide us with a breakdown of the forbearance loans and how you're managing them, and your provisions the bank is making for those forbearance loans? When I mention breakdown, I'm looking at sectorial breakdown, that is which one belongs to power, which one belongs to oil and gas, and that. Also, what is the current state of the lawsuit with Barbican Capital? I know the group has made some announcements when it started, but we have not heard anything since then. If you can still provide us with more details on what should be expecting, when will this lawsuit be resolved? Thank you. That's all from my end.
Okay. Excuse me. Patrick will take the core question, but I want to comment on the suit you referred to. You will agree with us that it will not be proper to comment or discuss any matter in court on this conference call. So unfortunately, we can't discuss that for obvious reasons. Thank you. Patrick, you want to take the forbearance question, or Shego?
I think they're referring to Patrick, the CRO.
It's me that will take it. Thank you, Chairman. Thank you.
Shego, okay.
No, it's me that will take it. The forbearance.
Okay. CEO, go ahead.
No, CBN has uniform requirement for loans under forbearance, and for ours, about 70% of so is in oil and gas, and about 15% into power, and then the other small manufacturing, agri, and others, like 5. So you have more into oil and gas sector, either upstream and services, more. I think that satisfies this general industry thing. And you should also understand the fact that these are projects with long gestation. Thank you.
Thank you,
Shego. David, you take the lawsuit. I want to start.
Sorry?
The GMB has already addressed that.
No, I've addressed it. I've addressed that one.
Okay, thank you so much.
Thank you. Tolu, let's go ahead.
Okay. So we'll take the question from so we have a question here from Damilare Asimiyu. So it says, first, I want to commend the continued effort of the management towards repositioning FBNH as the industry powerhouse. And the question goes thus: how optimistic is FBNH with its capital raise plans, the current 150 billion rights issue, and the proposed 350 billion, given that it's coming to the market at this time, and due to the internal yes, given that it's coming to the market at this time, essentially. And then the next question says, FBNH provided some stopgaps to some troubled banks between 2020 and last year. So as the bank fully recovered its injection, and also FBN cleared itself. Okay, I think the CEO just responded to the other part of that question. So those are the two questions from Damilare.
Okay, Damilare, maybe I should just respond. If you look at what we've presented to you today, you know that this bank is on an upward trajectory. We have our shareholders' confidence, and so we're not worried about being able to raise 150 billion naira. Again, I repeat, we started this before the regulatory pronouncement was made. And in spite of that, we're still going to get approval at the AGM to do another 350. We can't be that confident if we can't be moving that direction if we're not confident. So to answer your question, we're very, very optimistic that this 150 billion rights issue will be highly successful. We don't have any doubts at all. Thank you.
So the second question was just to reconfirm about the injection and if that has been recovered.
And on the second question, I think he was asking stopgap to some troubled banks and whether you covered. I reckon the chairman permits it, Segun, that should take it, the CEO of the bank.
Yeah, thank you.
Sure.
Thank you. We provided yes. We got our money back and we reported to the market that we were fully paid by Central Bank. So we are fine. Thank you.
Thank you, CEO. Okay. Take this question from Nabila. So say, what should we expect in terms of dividend for FY 2024? And then Elizabeth sent the next question, which says, given the high interest rate environment, impact on profitability, how sensitive are projections to potential interest rate fluctuations, and what strategies are in place?
Okay.
Maybe we can just take the... Yes, sir. We can take this third question from Fanny so that take them together. Which is, please, when is the next AGM holding and where would be sought? Okay, I guess that, and where approval will be sought for 350 billion to be raised. So when is the next AGM holding where the approval for the 350 billion will be raised?
Okay, let me answer that one straight up. The AGM date is 14th of November, which is published already. Okay, on Elizabeth's first question, high interest environment and profitability. Okay, CEO, you want to take that? Segun.
Yes, I'll take that. Thank you, Elizabeth. One good thing about First Bank is that in high interest rate environment, you do see us getting maximum benefit. If you check our deposits in Nigeria, over 80% of our deposits are current as CASA. That helps us to ride through high interest rate environment. We are sensitive to that. Now you have the CRR consuming and then increasing overall cost in the market. But it also means that the fluctuation, you need to manage it in such a way that at every point in time, you ensure that the deposit mix remain constant. And therefore, because we have very strong retail franchise, we are able to walk through a high and turbulent interest rate environment. And that's what you see with franchise like ours. Thank you.
You see you.
What did you
Nabila's
say?
question. So you just responded to the last question on Elizabeth. On the dividend, I
Okay.
think the ED actually touched on it earlier, but
Exactly
I
where I
don't know.
was going. SOA. Wale?
Yes, thank you, Chairman. Thank you, Nabila. Expectations for dividend for FY 2024 and subsequent years. As I said earlier, we said it is not very proper that in a period that you're raising capital, you asking shareholders to bring money to recapitalize the institution, particularly our crown jewel, First Bank. In the same year, you're also paying high dividend. I mean, question would be why ask us to bring the money and then cost of transactions and all of that. So what I've said, what we're doing is we want to settle the issue of capital raise, after which we're doing our SPP strategic planning for the next 5 years, 2025 to 2029. Then we'll be able to give clear indication of what dividend projection will be. But being that as it may, you can be rest assured that management is not insensitive to the fact that total shareholders return, a critical part of that is dividend, payout ratio, as well as capital appreciation. We're very conscious of that, and we are working the numbers to ensure that we give an appropriate dividend that does not hurt the business. At the same time, that is not a topsy-turvy, we pay today, we ask tomorrow. So we're looking at a holistic approach at getting the required capital into the bank and seeing the performance, then be able to project what dividend will be. But obviously, it is settled that 50 kobo, 40 kobo is not, it won't cut it. And we'll ensure that shareholders get appropriate dividend commensurate with the business. Thank you.
Thank
Thank you very
you.
much. We'll take our next question from Temitayo Motere. Please go ahead.
Good
Hello,
afternoon,
Temitayo.
everybody.
Okay.
Yeah,
Go ahead, please.
okay. So my question, I have two questions. If you look at the financials, impairment charges increased in the period by more than 100%. So my question is, what are the drivers of this significant jump, and what steps is the bank taking to ensure asset quality is managed? Then the second question is, part of the plans for the proposed capital raise is to expand. I heard the MD mentioning expanding outside the shores of Nigeria, but I've also read somewhere that the bank also plans expansion within the Nigerian market. So I want to ask if this is in line with customer sentiment when the industry is moving away from the traditional brick and mortar. Thank you.
Okay. Segun will take the question on impairment. But when we talk about expanding, we are not talking brick and mortar. Okay. If, for instance, you want to give Ghana, for instance, stronger base to operate, and you need to upgrade their IT or invest in digitization or innovation, that is the kind of expansion. Nobody does brick and mortar anymore in that sense. So just to get it right. And when you also talk about expansion, you could be referring to commencement of operations in a new country, like a greenfield or maybe an acquisition. So the expansion is not in terms of brick and mortar distribution, but we follow well-researched opportunities in identifying new business locations, just to get that clearly. Then second question on capital, no, what was that? Okay, impairment charges. Segun.
Thank you, MD. Would you like to replay the question on impairment so that we clear? Because I was trying to pick it, but I couldn't get it here.
Okay, so I was saying that
Okay.
if you look at can I go ahead?
Yeah,
Okay,
ahead.
go ahead. I was just going to read it out for him because I can see it on my screen.
Oh, really? I
okay.
was checking my screen. Not fine.
Yeah.
Okay,
Oh, impairment increased by 111.48.
Exactly.
Oh, okay. Thank you. You know, our impairment model takes care of a macroeconomic environment. So it comes to the model. So you have inflation, GDP growth, exchange rate, unemployment, as part of variables, stock market index, all coming to influence the PD. So these variables come. So it's not because of specific impairment, but because of the operating environment, your impairment model need to reflect that, and that's what we are saying. So, well, if you just look at it, even the cost of risk is still below what was last year, but our model reflect that, and that's what you see. And if you look at what happened in Q3, truly, and the currency environment, the rate raise, the CRR, many things in the operating environment, of course, ordinarily, it should reflect in the impairment model of financial institutions, because you are actually just securing the future. Thank you.
Thank you, CEO. Okay. There are no further questions at this time. None in the chat room, neither any hand raised. So in the absence of any further questions, we can then invite the GMD for the closing remarks. GMD, please.
Thank you, Tolu. So, ladies and gentlemen, I just want to thank you for being on this call today. We thank you for your questions, and we hope we'll be able to respond to all of them satisfactorily. We look forward to ongoing interaction with you, and just to say thank you for coming, and we'll leave it at that. Thank you very much. So
Thank you,
that
Jeff.
brings,
Yes, this concludes the FBN Holdings 9 months 2024 financial results conference call. Thank you very much, all. You may now disconnect.